Welcome to the weekly update, where we'll go over the action in the market for the week of August 15th through the 19th, and then see how things look for the week of August 22nd through the 26th. And our weekly charts continue to show some improvement, but on the daily charts, the last week, it ended up being a down week overall. And we had a pretty significant down day on Friday. So that's done a little bit of damage to our charts. It helped our weekly charts to not look as positive as they had been looking. So let's go in and talk about what happened and see how things look. So for the week session, the 4-week winning streak finally ended because on the daily charts, we'd really gotten to an overbought situation. We had gone up pretty far, pretty fast. We hit some resistance at the 200-day moving average on the S&P, although some other indexes actually got above. The Dow, the small caps, the mid caps, the NASDAQ and the NASDAQ 100 never got above the 200-day moving average. The real line in the sand is the S&P 500, and it went right up to that level and then has had a real hard time getting any strength to go back above it. In fact, it's been falling back ever since then. About the time we hit that 200-day moving average, the market had become overbought. So it spent a lot of the week retreating after testing its 200-day moving average. Another thing that happened is that China reported weaker than expected in their retail sales, their industrial production, their fixed asset investment data. All that stuff is showing a real slowdown in the Chinese economy. That's not a real big deal as far as from an American standpoint, but China is becoming more and more influential, and we don't really watch their markets or their economy all that closely unless you're interested in that or have some kind of a direct relationship with that. I'm mainly focusing on it from the stock market perspective, and it's really not a big player unless something really big happens that also draws the US into that. The NAHB housing market index, it fell to 49. Anytime we get a reading below 50, that's considered negative sentiment or a contraction. And this is the 8th month that we've seen a decline. So we're starting to see a real slowdown in real estate, and that's been happening over a period of time now. The Empire State Manufacturing Survey, that's the New York area, it shrunk to minus 31.3 from 11.1. So that's quite a big drop. This is the lowest reading that they've ever had in this particular survey. July housing starts were weaker than expected. Again, another real estate issue. Total retail sales were unchanged. They expected them to be up slightly when they were actually unchanged. Now you can take that as negative that they didn't show any growth. You can take that as more positive to say, well, at least they didn't go down and it was unchanged. Since retail sales are such a huge part of the US economy, existing home sales declined 5.9% on a month-over-month basis. This is the 6th straight month that this has happened. The St. Louis Fed President Byrd said that he's still in favor of a 75 basis point rate hike in September. So that's the more hawkish stance, that the Fed is still really fixated on getting inflation under control. Another Fed president, Neil Kashkari, who's also a voter, said that he does not know if the Fed can bring down inflation without triggering a recession. So that was taken a little bit negative as well. In the UK, inflation hit a 40-year high, my goodness, of 10.1% on a year-over-year basis. Germany's PPI, and this came out on Friday, and this really added more to the negative backdrop. And it was up 37.2% on a year-over-year basis, which is the highest reading in more than 70 years. So that's quite a long time. And that really suggests that inflation could be an issue in the UK, which then can influence inflation in the US. The 10-year note, after dropping below 3%, is now back above 3%. And the S&P was holding up. The week was going okay until we got into Friday's session. And that's where the negativity really came about for the week. So let's go back and look at this. The S&P ended up being down 1.21%. Volume is still below average. Now, this is the middle of summer. You've got a lot of indecisiveness right now, a lot of apprehension about things, so people aren't doing as much in the markets right now. The technicals, they're still showing some improvement overall on the weekly charts. They're still positive on the daily charts too, but we hit that overbought situation. We've been falling back and showing a little bit more weakness, where in the weekly charts, yeah, some of them declined a little bit because of the down week, but we're still seeing a general improvement overall. Inflation and interest rates are the real big concern these days. We have the whole list of geopolitical concerns, such as in China with the supply chain issues, the Russia-Ukraine thing that's going on, the China and Taiwan. You could go on forever. What we focus on here are the things that really have an impact on the market, and it's inflation right now. That's the real big focus. But any one of these other concerns could always come to the top of the list and take over. With oil, now we're going to be having some Fed speak coming out this week. I'll mention this at the end. They're having their annual meeting in Wyoming, and there's going to be a lot of speeches. There's going to be a heavy media presence at this. Chairperson Powell is going to be doing some speaking. So we're probably going to get some information from that, what the market does with it, how they interpret that. That's what we'll have to see. And then this recession debate. We are showing a slowdown in the economy, but the employment situation is still doing quite well. Those are kind of opposed to each other. So then you have this, what is a recession? Are we really in one? Is it a light recession? Is it going to get worse? Is it going to get better? And that really isn't helping things right now. Then the condition of our trend, it is a weakening trend, but it's starting to suggest that not very long from now, it could cross over and actually go positive. And I'll show you the chart. So let's go back and look at the week. Here on Monday, we had a pretty good up day. And then Tuesday was a pretty good up day as well. Wednesday was when we gapped lower. We almost came back to the daily pivot here. This is when the FOMC meeting minutes were released, but then we fell back after that. We were pretty much sideways into Thursday, but then Friday, there were no economic reports. There was the PPI that came out in Germany. That really added some negativity. We had this overbought condition that the market's been trying to work off. We gapped lower. We went all the way down to, it's not on here, but it was S3. That ended up being the low point for the day, and we closed just slightly up off of that. So we ended up being down on the week overall. The Dow was down the least at 0.2%, where the NASDAQ was down 2.6. The S&P was down, actually, I have it as 1.21%, and the small caps were down the most at 2.9%. And the small caps have been doing pretty good lately, and that's been giving some support to the market. But in this past week, they just didn't perform all that well. So this is looking back over the 5 trading days over the last week, where the Dow was down the least, and you had the NASDAQ and the NASDAQ 100 being down the most, and small caps were also down pretty heavily. This is going back to the all-time high, how these indexes have performed. Pretty much the same thing with the NASDAQ 100 and the NASDAQ doing the worst, but they're also helping to lead the way if we're going to go higher from here, because this is the growth area. And if we're going to continue to see that sector rotation from value into growth, we're going to want to see the NASDAQ and the NASDAQ 100 start to perform better, and that could bleed over into the S&P 500 as well as the other indexes. Let's look at the sectors. We had a down week with 8 out of the 11 sectors being negative. Communication was down the most, where it actually had been doing okay lately, followed by materials, real estate, the financial, and tech. The 3 sectors that were up were energy, utilities, and staples. This is kind of shifting back, at least right now. This is taking on the behavior that we saw more at the first half of 2022 with these areas like staples, utilities, energy, where they had been performing quite well and the rest of the market had been not doing so well. We'll have to see. Are we going to shift back to that going forward, or was this just a short-term play that'll eventually go back to what we're also seeing of that move from value over into growth? This is just looking at how the sectors performed on the week, with energy, staples, and utilities being up. Communication, materials, real estate, tech, all the other sectors ended up being down. Looking at our current market valuation, overall, they're still rating it as fairly valued. And here's the score of all of this taken together. We're above the dash line, so it is advancing. But as long as it's below this yellow line, it is considered to be fairly valued. It's not too far extreme. But if you look under the surface, here we have the yield curve. It still continues to be overvalued right now. It's really popped up above this yellow line. Then we have the Buffett indicator comparing stocks to GDP. It's also overvalued right now. And then the PE model that they use, it's also overvalued. We're above this yellow line here. Where the interest rate model, because interest rates are still historically low, even though they've been going up, that's considered to be fairly valued. Margin debt is also fairly valued. It had actually gotten undervalued a little bit. Well, with the little advances that we've been seeing in the market, people are willing to buy more stocks, and a lot of those stocks are bought on margins. So we've seen a little bit of an increase there. And our mean reversion model, how far away is the S&P at its current price away from the price that it has been historically? And this is still overvalued right now. So even though they're scoring this as fairly valued, I would kind of lean more towards the overvalued area if you focus on stocks in and of themselves. Then margin debt. Also, didn't I just have this one? Okay. I'm not going to go back and start re-recording this. Let's look at sentiment, where we're still back in neutral right now. We're right at 51, so we're not leaning one side towards the other. This looks at how things have been performing, and we're just about midpoint currently. This is the Chicago Financial Conditions Index. We're still below this black line, and it actually declined a little bit. So that shows that we're not seeing a lot of bad things in the economy currently. This is suggesting the same thing. This is the spread between the risky loans and the not so risky loans, and it's actually declining a little bit. When it gets dangerous is when this blue line really starts to spike up, and it has not done that yet. Now, looking at some Isabel net charts, this first one shows that equities have traded hand in hand with real yields. Real yields means they're taking inflation into account. So they're probably going to differ from when the yields that we look at on a day in and day out basis. And it just shows how the two have been moving hand in hand. This dark blue line is the forward PE ratio, and the light blue is showing the real 10-year yield that we're seeing, and it's inverted. So I measure this not on a real basis, more on a price basis, where I show a correlation, and when they're going in opposite directions, that's pretty much what you would see here, because they've inverted it on this particular chart. Also, this is having a mind of its own here. It is just suggesting that real rates, again, when you take inflation into consideration, they're still very, very low and deeply negative. You can go back all the way to the 1700s, looking at how interest rates have behaved through World War I. They've got World War II down here. This is where we're at right now, just showing that on a historical basis, interest rates continue to be very, very low. Another thing that's a bit positive is in this chart, we're seeing the biggest inflow into tech, and that's growth than what we've seen in the last 5 months. The light blue is the raw score, and then month after month, the blue line is just the 4-week moving average. And why this is bouncing around, I'm not quite sure. And then this chart says everyone is bearish, but no one has sold stocks. Now, I'm not really seeing that from this chart. Let's look at this a minute. The dark blue line are inflows into equities, and that's been coming back up. Where you have the allocation into equities, how much of stocks do people actually own? That has been dropping and now coming back up, but this still is a very low reading. So I'm not quite sure what they're trying to get us to interpret from this chart. The insider transaction ratio, it's starting to creep up, but it's still in more of a bullish to slightly neutral area right now. These are legal insider transactions. The CEO and different officers in a company, they know what's going on in their company. And if they like it, they might be willing to go out and buy some of the stock in that company. And a lot of people really follow that and use that to make decisions. This is showing that the S&P is only pricing in a 20% chance of a recession right now against a 75% at the peak of the Russian-Ukraine war, where fear was up really high. Now that's really dropped off. I don't know if I would agree with this. It's not that things have really changed in the Russia-Ukraine war. It's just they're not talking about it in the news anymore. It's still happening. There's still lots going on. People are still dying. There's still going to be economic fallouts from this. It's just kind of out of sight, out of mind, because we're focused on so many other things in the US media right now. But so that's more what I would measure this is what are people paying attention to? And that has really dropped off. They're just not focusing on the Russia-Ukraine war as much right now. This is kind of interesting. Again, we can interpret this in different ways depending on how you draw this chart in the first place. This just shows that the market cycle, because the market does go through cycles when it's up, down, sideways. We're actually declining here. And this could be negative because the bullish signals are starting to decrease. If we get down into this gray area, that's called the danger zone. But yet we're seeing other charts that are not suggesting that this is happening right now. So take this for what you feel it is worth. This also suggests in this next chart that the recession remains the consensus as of August. This is just the people that are saying that a recession is likely is very, very high, no matter how you try to define it. All right, let's go into some of our other charts here. This is showing the RIDEX bear bull ratio. We're kind of midpoint now. You have some people that are bearish and you have some people that are bullish. We're not spiking either way currently. Then we had the recent survey put out by the American Association of Individual Investors. After giving an extreme negative reading, we're bouncing up and we're not necessarily extreme right now, but with a slight negative bias. The VIX, after declining with this past week, it did turn back up slightly and we were dropping down below 20. That's kind of the static number that a lot of folks use, that 20 and above is considered extreme fear. Well, we spent a lot of time above that. So now you have to look at more of the relative numbers. Usually when we get down to 12, that's when we have extreme, when people aren't hedging. Complacency, that's the word I was looking for. We're far, far away from that right now. The ulcer index on the weekly chart, this is still helpful even by looking at the daily chart. This is showing that fear is decreasing slightly, but still fairly high, kind of in about the middle, pretty much what our other sentiment indicators are suggesting. Copper has been really declining, but has been trying to make a comeback. And that might suggest that the economy is looking a little better into the future. Some of our daily scenarios, and again, I usually only deal with this in the daily videos that I post, but because not all of you watch all of the videos that I post, I want to go through this just to make you aware of this. So, and that's what makes this video a little bit longer. These are some positive setups that we're seeing, and they've been on the table now for quite a while, and they're still on the table. And so we want to keep an eye on these to say, is the market going to go higher from here? These charts suggest, yes, that it could, but we have then taken a short-term pause in that. So first we look at the percent of stocks that are above their 200-day simple moving average. After going extreme negative, it's bounced back up, and this is a daily chart, but then in the past few days, this did decline. That's one positive setup. And if you compare below when we hit extreme negatives, that oftentimes was either at or near a low in the S&P 500. Here's another study. This is looking at the S&P 500 with those stocks that are above their 50-period moving average. We had gone extreme negative. We popped all the way up to go positive pretty quickly. We've come off of that a little bit as the market's been having a little bit of trouble, but this is suggesting there's some thrust. There's some positive action coming into the market. Now, we don't just look at the S&P, we also look at the mid caps, and we're seeing a very similar picture as with the small caps. Even though it's come off of its high, we're seeing some confirmation between large, mid, and small caps. There's some buying coming back in. So that is one of the positive setups. Another positive setup is when you take a 5-period simple moving average of the equity put call ratio and it spiked up. That's when we hit the low. And then since then, we've been coming down. And a lot of times that will mark a low in the S&P 500. So now we have another confirmation of that. Here's one that I'm kind of relying on a little bit more heavily. There's two that I really like. This is the sector rotation. This is going from value into growth, where at the end of 2021, we saw it going from growth into value. And then that's where I have these red lines here at the end of 2021. And then we saw some real problems after that. Well, we started to see some positive divergences, and they're still going higher overall, even though we are seeing some shorter term weakness. What I'm really looking at here is the moving average. As long as the moving average is still going up, okay, we're fine with that. If the moving average starts to roll over, then I'm going to get a little bit more concerned with this. Here's another chart showing large, mid, and small cap growth against value also has been showing a positive divergence, even though we're seeing some recent weakness. There's small caps. They pretty much have been sideways since they had kind of a difficult week where we had seen a spike up with the small cap to S&P 500 ratio. Well, it's now falling back. When it did spike up, that gave some support to the S&P. As it's been falling back, now we've been seeing a little more weakness in the S&P 500. There's another setup where we take a 10-day average of the highs and the lows in the S&P. It had gone extreme negative and is now still quite positive overall. Another one is looking at a broad market measure of the Amex, NASDAQ, and NYSE. It had gone extreme negative and is since showing a nice recovery and this is more broad-based. And if you look at this, when this really made some extreme negative readings, quite often that will mark either a low or near a low in the S&P 500. This one isn't as strong because interest rates are starting to go back up. It looks like the 2-year yield may have spiked and has been coming down. Well, now it's starting to come up again. So I'm not putting as much importance on this one. This is staples, the things that people have to have no matter what's happening in the economy. After having a recent death cross, we've since seen prices start to rebound, and they're actually above both of the moving averages. How I look at this is we take a ratio of the staples to the S&P, and that's this lower chart here, and it's spiked up, and then we've since been declining. And a lot of times that marks a low in the S&P. Well, it's been coming back up recently as we've seen some weakness in the S&P. Doesn't mean that this is off the table. We just want to keep an eye on this and see if this spike that we've been working off of that was set just about at the low, if that still continues. All right, let's go into earnings. Looking at the Shiller PE ratio, this still suggests that stocks are quite overvalued currently, where we're at 31.68, where the median and the mean is between 16 and 17. So that, again, on a historical basis, stocks still remain expensive. Now, you can go forward and use forward PEs, and they're looking better. But at some point, we need to look backwards to see where are we in relation to what we have been historically. And then FactSet, there were no blog posts this week. So I'm just thinking that maybe they are on vacation right now. The earnings estimates, this is Morgan Stanley, which tends to be a little bit lower than the rest of the market. And it's just projecting out what they think the earnings will be for the rest of 2022 and into 2023. FedWatch, Okay, this goes back to August 5th. There was a 68% chance that we're going to have a 0.75% rate hike at the September 21st meeting. Then last week that dropped to 45 when we saw the weaker economic reports. And currently we're at 41%. So, and there's a lot of time for this to still work itself out, but this has been lowering right now. This is the Fed balance sheet, which they're going to kick into gear more of their tapering, more of their tightening, whatever you want to call it. It is starting to roll over, but it's going to become a lot more starting in September, I believe, is when that's supposed to start. Looking at breadth, still looking okay based on price and volume, but we have seen some recent weakness in the past week. The advanced decline ratio, after getting almost extreme with the 19 EMA, we have come back down. We're still positive overall because we're above zero, but this has shown some weakness. The new highs, new lows continues to advance, both on the 4-period and the 10-period moving averages. Accumulation distribution saw a little bit of weakness, but we're still above the moving average. Looking at our trend, this is what I'm talking about. The red line is just about ready to cross below the green line. That would turn this trend positive, even though we're seeing a weakening trend, but we're well above 20. We're still in a positive trend on the daily chart. Here's the Arun showing that there's been a decrease in selling, also a decrease in buying. So we're flat overall with our oscillator. The mass index, we're still working off of that signal that was generated pretty much at the bottom that we saw. And we've been seeing some nice upward action in the S&P up until this past week. There's been no change in the decision point scorecard. Still have their short and intermediate term models and signals are positive, or long terms, pretty much what I'm showing. We still show a negative trend. Here's the daily chart where we were able to get back above S1. We never got up to the pivot, but that would really help things quite a bit if we could get above this pivot area. Or are we going to fall down and break below S1? Looking down at the bottom, you can see how volume, that's the red bar down here. We were way below average. We're still below the 50-period simple moving average, so that is negative. The long-term trend, and you're going to hear this a lot in a lot of these charts, showing improvement, came up to the 200. Actually, this is the 50-period, which equals a 200-period daily moving average. And then we came down from that. BPI, this is still kind of extreme positive, even though it showed some weakness over this past week. The Chaikin oscillator long-term came almost up to an extreme reading and has since turned down. Chaikin money flow, still pretty much flat overall, not really giving us much. The force index declined a little bit, but is still positive. McClellan oscillator, after being extreme positive, has worked its way down and has almost switched over to negative. Summation index based on price, looking a little extreme. It could go higher than this. It didn't turn down yet, but based on price and volume, still continues to be positive. Our oscillators, if you use oscillators on weekly charts, they're still pretty much positive. In fact, they are positive across the board. The Swinland trading oscillator showed a bit of a decline based on price and volume, but we're still above zero. The PMO is starting to turn up. Again, if you use oscillators on weekly charts, price is still showing in advance as well as volume. And then the PMO study is showing that we were extreme positive with those PMOs that were rising. That has declined, but it's still positive overall, but it's going to need to turn back up. The buy signals are still extreme positive, and those that are above zero continues to advance. The RSI, after getting above 50, has started to turn back down with the negative week. Special K continues to be positive overall. The Stochk RSI still extreme positive. Williams percent R extreme positive. Vortex still positive. It crossed over green last week and it's still hanging in there right now. Ultimate oscillators just hanging out at the extreme positive reading. Money flow indicator also still going up and not necessarily extreme. Bollinger Band's pretty much neutral right now with our percent B measurement. KSD, this is positive. This is a long-term measurement tool, and it's just crossed over positive. It did last week, and we're seeing a continuation of that currently. The PPO, this is also the first time in a long time we've seen the percentage price oscillator switch over positive, so that's looking better. The rate of change going back 1 week was down slightly, but not necessarily extreme. We're still doing okay going back 50 weeks, or roughly 1 year on these charts. We're still working off of a Copic curve signal. It pretty much triggered at the bottom, and the S&P has been going up. Now, the Copic curve does not tell us direction. It just tells us something is going to happen. We use other charts then to suggest that we were going to go up, and that's pretty much what has happened so far. Weekly, we came up above this 40 period moving average and then have dropped back down on the weekly Fibonacci chart, but we're not really hitting any levels currently. The Heiken Ashi is still looking positive with open candles. The Kegi is still positive. The Renko is still positive. The ease of movement actually showed some improvement. And we had a new X drawn into the point and figure chart, so we're still working off of a triple top breakout. The 3-line break is still positive. Our Elders impulse system is still positive. The parabolic SAR is still positive on the weekly chart. We did see a negative dot drawn after Friday's session on the daily charts. We'll want to see if that is telling us more than we might think right now. This is just a shot of the large, mid, and small caps to show how they've been pretty much going hand in hand with each other. All stocks, after really declining, showing some improvement, have now seen a recent decline, and they're still in an overall downtrend. Mid caps, and this is where it's going to be a broken record. Slightly above the moving average, fell back down, still in a downtrend, but showing improvement. Small caps, very similar situation. The Dow actually got above its 200-day moving average on the daily chart, which is a 50-period moving average on the weekly chart. NASDAQ, it never did, but it is still showing some improvement even after having a down week. NASDAQ 100, very similar situation. NYSE, Wilshire, 5,000. The FANG stocks, they were down slightly. ARC had a pretty nasty week. It was down over 14% after it had been trying to stage some kind of a rebound, but is still in an overall downtrend. The 30 biggest software companies, the weekly chart, were still below the moving average. Then here's Dow theory, showing how the Dow, the transports, they've been really confirming each other. We're seeing some recent strength in utilities currently. And all stocks, didn't I just show that? Okay. And then the CRB index still in an overall uptrend, showing some weakness, but was a little bit down on the week. Gold tried to start to come back a little bit, but then has shown some recent weakness. Same thing with silver, still in an overall downtrend. Oil is right at 90.44 currently. The dollar weekly chart, after showing some weakness as the S&P was going up, with the S&P having some trouble this past week, the dollar staged a pretty nice rebound. And then we're still trying to figure out, have bonds bottomed? And have they built a base, and are they starting to come up out of that? Not this past week. They lost some ground. And this is showing how interest rates had been coming down. This is a daily chart. But recently, we've seen interest rates starting to go back up. Some of our relative studies, oil still has performed the best, followed by the dollar, where gold stocks and bonds tend to be negative. Not tend to, they are negative since the beginning of the year. Bonds are underperforming stocks. On a monthly chart, stocks are outperforming bonds. And gold, which has been having some trouble, where we're seeing recent strength in the dollar, so this ratio has really been declining. The gold to the S&P, which gold had been doing pretty well, but has since seen some real weakness, so it seems to be breaking down now. Low volatility stocks still are performing fairly well when compared to the S&P. Growth versus value. Growth had really been declining, seeing some rebounding, but in the past week saw some weakness. NASDAQ 100, which is growth, had been bouncing up, but not this past week, so it turned down slightly. S&P 100, growth against the rest of the S&P 500, trying to get a little bit better here, and actually was up slightly. Discretionary had been really underperforming, showing a bounce, but then some recent weakness. Energy to tech. Energy was really going up, then falling back. Now energy has been outperforming tech. So what's our outlook then? Well, we have some reports that are coming out. We have the IHS market manufacturing and the service PMIs. These aren't really big reports that are coming out, but we still want to pay attention to them. We have new home sales coming out on Tuesday. Wednesday is durable goods. Thursday, this is going to be kind of a big one. It's the second GDP report to see if there's going to be any adjustments to that. And we have jobless claims coming out. Then on Friday, we have personal income and spending and PCE prices. And this will be when we get another inflation reading. It's different than CPI. And PCE is what the Fed likes to use to measure inflation. So the markets will really be anticipating that. And then we'll get the final reading of consumer sentiment. So the technicals, yeah, they're showing some improvement, but more recent weakness overall. And I have this in gold because inflation and interest rates are the real focus. We have geopolitical concerns, the supply chain issues, oil, and then the Fed speak is also highlighted because of the meeting coming up in Wyoming this week. So our scenarios, and these are based on the daily charts. We really can't go down yet, but any one of these reasons listed here could come to the forefront and really push the markets lower. They could also have an inverse effect too. The technicals, they're positive on the daily charts, but they're showing some weakness right now. We're still going with the up scenario because they're positive, but they're starting to really stall out. There's a real disbelief. You've got a lot of people who are just completely convinced that what we've seen in this bounce, that's all we're going to see. It's a dead cat bounce and it's going to go lower after that. And that might be what happens. But we're also seeing a lot of evidence of a real shift underneath the surface going back into growth, and that's what the smart money is doing. And I have to pause this. Okay, hopefully that didn't produce too much of a break in the recording. We're still going with the up scenario because our technicals are positive, but they've been stalling. As I mentioned, there's a real disbelief that the market's even going to go any higher. But then if we break above that 200-day moving average, there's going to be FOMO, or the fear of missing out, where people are going to go, wait a minute, the market's not going in the toilet. I better jump back in, or I'm afraid that I'm going to miss out on what the market is offering right now. We don't really know how that's going to play out. We have a lot of evidence to suggest that we could go higher from here, but we have to be realistic at the same time and look at what our charts are telling us. And there's some weakness that is developing, but there's also some strength. So we're kind of in between right now. Then there are positive scenarios that we're looking at with the sector rotation. Yeah, it's still positive, but it did weaken this past week. And our positive setups are still on the table. But that doesn't magically mean that that's what's going to happen. It has been what's happened in the past, but we don't know how long this could take to actually play out. Technicals are still positive on the daily charts. They're improving a lot on the weekly charts. The big one right now on the daily charts is the 200-day simple moving average. If we can't get above that, that's the line in the sand between positive and negative, and that's really not going to matter. And it could take a little bit of time for that to develop if that's what ends up happening. We're not going sideways right now, either on the daily charts or on the weekly charts, so we can't really use that as a scenario. So thank you. I almost got through this video before I had to pause it, but I hope you find this helpful. I do have the daily full-length video posted as well as a brief, and I have the intermarket analysis video. What I would like is if everybody could watch all of the videos, that would really help me out a lot, but I realized that not everybody has the time to do that. That's why I'm mentioning some of the different things in all of the videos that I post. So with that, have a very good week, and I'll look at preparing next week's video, and hopefully things will be a little bit more clear at that time.